The differences between exchange-traded notes, ETNs, and exchange-traded funds, ETFs, are notable. A key distinction lies in the type of market risk each faces. ETNs are subject to default, liquidity, and market risk, whereas ETFs face market risks tied to the value of the assets they track. ETNs, essentially unsecured debt instruments issued by banks, have their value linked to the bank's credit rating, making them similar to bonds. If the issuing bank were to go bankrupt, the ETN would become worthless. Additionally, ETNs are thinly traded, which can result in wide spreads between asking and bid prices, thereby increasing liquidity risk. In contrast, ETFs, which diversify their investments, mitigate market risk, making them less risky than ETNs. Tax treatment is another area where ETNs and ETFs differ. ETNs do not generate taxable income until maturity or sale, with investors only paying capital gains tax upon selling their shares at a profit. Most ETFs, on the other hand, pay dividends, resulting in taxable income. For instance, holding an equity ETF for over a year would lead to capital gains tax, as well as tax on the dividend received. This makes ETNs more tax efficient than ETFs. Tracking errors also vary between the two. Banks issuing ETNs typically track futures, options, and other exchanges to achieve promised returns, eliminating tracking errors. In contrast, ETFs can encounter tracking errors, which occur when there is a difference between expected and actual returns. These errors can negatively impact portfolio managers and deter new investors. As a result, ETNs avoid tracking errors, reflecting positively on their overall performance. Despite their differences, ETNs and ETFs do share some similarities. Both track the performance of underlying assets and have lower expense ratios. Trading on major exchanges like stocks. When comparing the two, it's essential to consider individual investment goals and priorities.